All right, so here we are in the After Hours show with John. Welcome back. That was a great interview we had earlier. So I want to kind of just start this conversation because you live out in Las Vegas, and
Yes.
the impression, of course, I get when I hear someone living in Las Vegas is that well, you live an exciting lifestyle, and but then I found out that you're actually doing law school at night. Like, who in Vegas, instead of partying, you're going and doing law school? Like, what's up with that?
Yeah, I know it's weird. Like, I love like growth. Like, self growth is kind of cool. And like that book, The Golden Micro Edge, was like a 5.5 year endeavor. So it was great because I got to explore myself and memorialize all these strategies. But really, like, it it's kind of cool to go back to an environment where now you're being taught, where you're learning, you're being pushed to analyze things and look at things. And ultimately, law school's about it's about many things, but to me, it's about advocacy. How do you advocate a position? How do you convey a position? How do you succinctly and persuasively compel someone to take action? And honestly, I was poached by a Facebook ad. Can you believe that? I mean, I'll admit it right here on the After Hours show. I was surfing Facebook and I saw a Pepperdine Law School ad, and I'm like, you know, that makes a lot of sense. I'm gonna go, and I clicked on it, and it was over. Literally five
Well,
weeks later, I was part of the spring 2019 cohort for Pepperdine Law School, the online Master Legal Studies program, and
well,
I
that's a
spent a lot of
great
time reading law. So yeah,
that's a great story. But most people that go to Las Vegas and try to do some personal growth, and you were saying you're being taught. I think they usually taught different things, especially at night. I would say than what you're learning. So now, also,
like.
you're not.
Mhm.
Sorry, go ahead, John.
No, I mean, you know, I've lived in Vegas for 15 years, and I lived in New York City for 8 years, and I did the bi-coastal thing, and I also spent a lot of time in Santa Monica. I got to tell you, like, I am pretty boring. This whole trading futures thing full time, like, it kind of provides you with a sufficient amount of adrenaline when you like support yourself from your trading P&L. So the last thing I need on a Friday night is like I used to be a big sports bettor as well, but like that was like a lifestyle choice to okay, no more of that. Futures trading, high leverage. This is probably enough adrenaline for me at my age.
Right. So you used to be a sports bettor. So let's talk a little bit about that because did you actually go out there to be a professional sports bettor, and what did you bet on, and like how did that work?
Yeah, no, I used to be very active sports bettor, also a poker player. Played a lot of. We're talking now 2004 to 2006, which was kind of like the first sort of post Chris Moneymaker golden age of poker. Living here was great. I was living in California up to that point in time. Um, had a lot of things. There's a lot of shows here. And I just love Las Vegas. Like it's there's no state income tax in Las Vegas, which is great if you're a native Californian to come and live here. And the bad guys, I'm all about like creating structural edges, guys. You know. So I just and I was also featured in a movie called Life on the Line. You can watch it on Hulu, I think, where in 2010 they had a camera crew come around with me and some other sports handicappers as we like bet the Super Bowl, and they were filming us for a week, and it was really a lot of fun. So I mean, again, I've had a lot of memories and fondness of sports betting and playing poker, but like I have a 2.5 year old daughter now, and like honestly, trading the Fed with leverage futures contracts is seriously enough juice, guys. Like it's a lot of juice in that.
So did the skills that you learned doing the sports betting and doing the handicapping, like did you? It sounds to me, at least, and I don't want to put words in your mouth, but you've almost taken that idea and put it into these events, and you're looking for those same kind of edges, and you're just being very methodical about it. Because that's the one thing about that people don't realize is that professional sports bettors, it's not that it's also boring because it's a job and they have to go and treat it seriously, and they're not taking wild risks. They're trying to figure out times when the odds favor them and then betting bigger at that point. How much of the skills from sports betting are you applying on your actual futures trading?
Well, it goes both ways. I mean, speculation is a skill in of itself, right? So when you think about, how I manage risk, bankroll management, what the netto number is, okay, like how I maximize return punitive risk. Make up a number here. I have $1,000 sports betting bankroll. What does the equity curve of my sports betting bankroll look like? Is it suggested that I have an edge? What does the equity curve of my trading look like? Is that suggested that I have an edge? So I think, it still comes down to, can you identify opportunities where they are mispriced, and then do you bet the appropriate amount based on that confidence interval? And that's something that, whether you're betting on sports, you're playing poker, or you're betting on the markets, is a skill that transcends all of those industries. But there are different structural impediments or challenges with each one of those respective things. For example, as a poker player, you can play online, you can play live. If you play live, there's certain limits, there's certain house rules. You may face some constraints. With sports betting, you could face jurisdictional legal issues, not here in Nevada per se. Also, liquidity may not be as good if you're in the market. Are you trading futures, stocks, options? So knowing the rules of the game, which is actually something they just pound on you in law school, like you have to know the jurisdictional rules, which is like why we love using that word jurisdiction. If you're going to have an expertise and have an edge and be successful.
Okay, so now, where is the
that's
best
my after hours
example?
talk there. This is pretty intense.
Right. So where is the best example of using that edge today? Like, where are you focusing your energy? Like, you told us about the Fed minutes and that you're trading these events, but do you have anything else, or do you have any trades that you're like feel really strongly about that, something
no
a little
doubt,
more
no
kind
doubt,
of
no doubt,
yeah,
no doubt.
Why don't you
I think right now the trade is, let's just follow the big money flow. There's a broader theme taking place in the markets, and again, I should stress that the event trading is one, although an integral, it is only one aspect of all of my trading. Because if you simply become myopic on just one event and you haven't taken, a mosaic of information, and you don't have a broader appreciation of what's also happening, that can inhibit some of the P&L potential. But to your question about what trade I like right now, I think we're in a global freaking chase for yield. Okay. And what that means is that at a broader, deeper, more strategic level, people and portfolio managers have been chasing yield for some time now. And what that means is, if you have a theme, a macro narrative, a regime where I need to own long end of the treasury curve, all right, then you need to use, then taking that and saying, okay, well, what else is out there? Well, let's look at dividend paying stocks. XLP, for example, the ETF, as I look at the S&P right now, that's positive on the day. XLY, okay, XLU. Those are the parts of the S&P that are actually up today, whereas your beta names are down. So being aware of this beta versus dividend paying, understanding which part of that cycle we're in, can still lend opportunities. You can still take these fundamental themes, all right, watch these money flows, and then apply a very tactical approach to this. And for me, it's using this weakness in the treasury market to step in and buy it. Like, if we get a headline and the treasury sells off 5 or 7 basis points, that's check to come in and play a day trading scalp, all right? And that's what I talked earlier about being an analyst versus being someone that can make money, all right? The analyst talks about how interest rates have never been this historically low before, or, this is something. The trader says, okay, they're low, and there's this theme, there's this money flow in place. Now, how do I tactically take advantage of that, all right? So for me, that trade right now is this broader chase for yield. And when you look at the S&P 500, it's very tough to see that going down too much, as long as the dividend yield in the S&P 500 is paying more than 2-year dividend yield, even 5-year dividend yield right now, or the 5-year treasuries right now.
Okay, so you're understanding the macro trends that are in place and looking for selective opportunities to kind of take stabs at it and take some good good risk return bets. If I understand
Place good
correctly.
tactical bets based on those themes. Correct. Yes.
Right. So now, for example, let's talk about XLU. It's up on a stick. It just continues to go higher no matter what. At what point would you be saying, this is getting frothy, it's getting risky, or at what point would you say the trend has changed? Like, how would you take that macro theme and identify when it is shifted?
Watch your P&L, my friend. Your P&L will tell you when that macro shift is shifting. Okay. When I buy the dip 3 times and I'm looking at brackets instead of green, you know what I mean? When I got parentheses around the trades of buying that dip on the XLU, that's a good sign that maybe the macro trend is changing. And I don't need somebody on CNBC to tell me that, rates are going higher, I'm going to short utilities. You know what I mean? Because if I'm doing my job, if I'm identifying these opportunities, but guess what? I may make 8 out of 10 or 15 out of 20 winners before I see that degradation in that strategy. Okay.
Right.
And so that flow is one of many things that I like to do is P&L attribution. P&L attribution can be so vital to understand the macro narrative and looking at the market through that. All right, well, what's the Netto number on that? Is the Netto number, is the return period of risk beginning to decay, which we talked about extensively in the Global Macro Edge, how to use the Netto number, what the Netto number is, how to compute it, etc. But that's the first way, P&L and Netto number.
So 1 second, Patrick. It's Kev still. Yeah. Because this is one of my pet peeves is that I find a lot of people that say they're technical analysts and they're all trying to fight the stock market rise. And I've always said, aren't technicians supposed to be more kind of aren't they supposed to be more trend followers? And you just said, John just kind of pointed out, he said, as long as it's going up, I'm going to continue doing it. And to me, it's still going up. Sorry, go ahead, John.
The context of that, though, is critical because pigs get fat and hogs get slaughtered, okay? And you can be a mean reversion trader and do very well. You can be a trend follower and do very well. Technical analysis is the tool that facilitates those strategies. But to me, understanding the macro narrative behind the technical analysis is at its core the global macro edge. So if you want to be on some time frame or based on some strategy, you want to sell premium, you want to buy premium, you want to sell tops, so you want to, when you get oversold or overbought, that strategy, and you can overlay a macro narrative on top of it. For example, the S&P 500 has been rallying like crazy, okay, over the last 7 years. So shorting it just simply because you want to short it makes no sense to me. However, if we get some technical bearish formation and you compound it with a Fed press conference where all of a sudden Powell surprises us and says, despite the market pricing us in, we still find the data very encouraging and we remain patient. However, at this point in time, market expectations for rate cuts may have gotten a little bit ahead of themselves. Okay. Now I'm going to ask you a question. Okay. At that point in time, the next sell trigger again in the S&P has a lot more teeth to it. Okay. If I have a moving average crossover, that's some basic entry system because Powell just freaking dropped a bomb on you. All right. So guess what? No matter, now you can overlay the technical analysis with this fundamental regime shift. Okay. And you can use that as a way to get in and you can use it as a way to manage your risk.
Right. So at the end of the day, that macro understanding is what's driving trades, and you're using technical as a timing tool and a risk, as a way of establishing good risk reward trades.
And on top of that, quantitative analysis through unit of risk ratio, such as the Netto number, agony ecstasy ratio, to take a more broader look at the market and analyze different aspects of it to identify where money flows are at. So by combining with what I just told you with, and also money flows on top of that are now going to the wrong end because in that case there, I'd buy 30 years, I'd buy 10 years futures, I'd sell S&P, I'd sell high yields because guess what? You know what I mean? I'd buy the dollar, I'd short emerging markets on all that scenario right there. So I build all these things. I could hit one button or I could have it automated and boom, done. The basket goes out. I'm in. And we didn't even talk about how I can structure that around options, okay? Because I'll tell you this, the options market maker doesn't know the macro narrative like I do. He doesn't have these tools.
Okay, so let's talk about that. The option trader is just looking at it's often I used to be an institutional equity option market maker, and I understand that when Patrick comes to me with his strategies, no, honestly, Patrick, I'm impressed by your strategies. I always kind of look at them and you're creating positions that will behave a certain way based upon what you think the market's going to do. I didn't look at that at all. I looked at implied volatilities, and I was either long or short gamma, and I was worried about the volatility around that price, and that's all I cared about. And I never once thought to myself, well, I think I could create a 2-to-1 call spread or whatever. That was never a trade. Because I was always delta hedging it. So there is a possibility, and I've come to realize and appreciate Patrick's kind of approach where he can create positions that benefit from specific market outcomes. So I'd love to hear, John, you talk about how you could use options to create risk reward scenarios that are favorable to you, and while combining it with your macro kind of understanding.
Sure. So there's a couple of factors to that. One is what I would define as temporal granularity. And by temporal granularity, I mean that we have so many options now that have so many different expiries. So the temporal aspect obviously being the expiry and the frequency of those expiries. The granularity meaning I can buy them every 50 cents in crude. I can buy them every $5 in gold. I can buy them every 5 points on the S&P. So we take an event like maybe a non-farm payroll or an election results or some sort of macro event. And because I can buy an option that expires tomorrow, you as a market maker just simply don't have the background or the comprehension of that in a large enough data set. You could appropriately price those options. So now not only am I just simply making a directional call, I could define my risk. And in a market where premium selling has done so well over the last 5, 6, 7 years, I mean, most of the, we have had a few XIV moments, but by and large, people who have been buying options the last 5 years more broadly have been struggling, whereas those who've been selling have done particularly well given this record bull market and the vol suppression we've seen with central bank puts out there. However, when we find situations where the market has been caught offside, like back in December of 2018 or other events, the one-day options expire that are 20 points away. Well, you I'm sure would say, gee, the S&P only sells down 2%, only has a 200 basis point move 1 out of every 79 days. Okay. So based on that, I should price this option 2 points, but that's incorrect because what just happened puts us in a category where the chance of moving down 2% is actually 30% on the day, not 2%. Okay. And so that temporal granularity provides opportunity that when there is a shift, when there is an event that happens, you can take advantage and exploit that because what now being that most of this options market making stuff is automated, they're using large data sets. The big firms out there, the Citadels of the world, all those firms that are making markets here are rigorously quantitative, but they don't get the macro context for those unique opportunities, and that's where they must be exploited.
And so you're generally a buyer of options. You're not, and you're just looking for kind of situations where you think that the possibility of a larger move are underpriced and underappreciated by the market makers.
Just like Toronto was underappreciated against the Golden State Warriors. Toronto came into the series as a 2% dog. Whoa. Yeah. I just dropped that bomb on you guys. Okay.
Yeah, no,
so out there.
So wait, so you were a sports bettor? What did you think going into it? Like what were your thoughts?
I made the series pick 'em, and it's easy to say in hindsight, oh, gee, you made the series pick 'em because, and believe me, I listen to the Decent Network. I love the show. I have many, many former colleagues who are sports bettors, so I can still make a market. In fact, I made one of the first in-game betting models here in 2010 when Cantor Gaming introduced in-game betting to Las Vegas. And so I'm routinely, if you even go back to my tweets from the U.S. Super Bowl, I'm like putting out, in-game sports lines, over-under. So like I'll make a market on a sports bet on a series in a heartbeat, okay? And I made this series pick 'em, all right? But again, it's just one more thing to deal with that I just don't sports bet. I haven't been a sports bet in 6 years.
All right.
Okay.
So what did you, 1 second, what did you see? Why did you feel that way? Walk us through your thinking.
In a similar way that my unit of risk ratios, if you want to refer to them metaphorically, about the Golden State Warriors, were suggested that this is a team that was fading. The metrics, like, so for example, I measure what's called max favorable excursion versus max adverse excursion on a market. So let's say the S&P today is up 20 points, and at one point in time was up 20 points, but another time was down 40 points, okay? And let's say it closes unch. To me, the fact that it was down 2 times the amount that it was up is instructive, okay? And could lead to understanding. Just like if you look at a strategy, if you find that it's taking a lot of drawdown, but okay, it's still making money, that could be a warning sign that there's model decay in that strategy. So let's look now at the Golden State Warriors if you want to find sort of an analogy of how it would transport over that unit risk ratio to the Golden State Warriors. In the series against Portland, in the 4-game sweep, all right, Portland led the majority of time in that series. The matchups which Golden State was able to exploit pertain to Portland not having their starting center. The length of Toronto presented particular matchups without Kevin Durant, because Kevin Durant is your 20-foot spot-up shooter that can basically negate the edge. And you saw that when Durant came and played. There's no doubt in my mind if Durant's healthy, Golden State wins that series in 5. Okay? He was that much of a matchup edge against Toronto that if Golden State's at their full strength, you're talking Golden State's probably -5, 550. Okay? However, given we're going through with that, given the lack of that key matchup edge with Durant and the home court advantage and the athleticism of Toronto to now actually force Curry and the ability to defend, because Durant is a huge defender as well, he had a huge impact. Okay, and people were asking the wrong questions. So for me, I made the series pick 'em. All right, and obviously Golden State was a $3 plus back was $2.60, and the money came in from a lot of retail people out there on Golden State. Now, some professional bettors here in Las Vegas, more Toronto side, they were never going to lay the $3 with Golden State. But that series was a classic example of, let's look at the last 5 years, let's look at some other stats, and we'll make Golden State the $3 favorite. That was just a fucking misprice. Sorry, that was just a misprice.
No, that's perfect.
Misprice.
Okay, so you said the bettors were asking the wrong questions. What are investors asking the wrong questions of today?
Oh my
Back to
God!
the
Don't give me another layup question like that. So the problem
Come
is,
on, though. Like I
asking,
would love to hear it.
Yeah, investors ask, "What are my returns?" when they should be asking, "What are my returns per unit of risk?" And understanding what your returns per unit of risk are means that going into an investment, what is my risk budget? How much am I risking in this investment? Because if somebody want to say, "Oh, I made 10%," well, 10% relative to what? Were you risking 10% of your portfolio? Were you risking 50% of your portfolio? Or were you risking your entire portfolio? What was the nature of that risk? How leveraged was that portfolio? What capacity constraints were there? Is this scalable? Okay. Simply saying what were my returns is not the right question. And what I do, and it sounds a little pitchy, and my apologies, but you got to know the right context, that three-dimensionality. If you don't know what those returns were relative to what was actually at risk, then you don't have the complete story. And you're likely to make serious, significant investment mistakes as a result of that.
No. Well, that's words of wisdom. Words of wisdom. All right.
Words of painful experience, more like it. Yeah.
John, you know what? Listen, I'm just going to make the pitch again. Our listeners, make it out to Chicago and join Kevin Muir, John Netto, and myself out for drinks after this Macro Edge event on Sunday, July 21st. There's no tickets or anything. We're going to announce what bar we're going to be drinking at, and our listeners are going to be welcome to join us and for a couple drinks and shoot the shit. And it's going to be a great time out in Chicago. So,
Patrick,
John.
one second before you said a couple of drinks. These are Chicagoans. I'm sure it'll be more than a couple, but.
No. Okay.
So
we better be drinking sessionable beers then.
That's right. They better be sessionable.
But listen, John, it was great to have you on. This conversation is going to be continued. Like it was great.
In Chicago and
Chicago
great, guys.
And next time I'm in Vegas, we'll have to go for a couple drinks, as long as it doesn't interfere with your law school.
That's right. It was a pleasure meeting you, John. I'm looking
good reading material for you.
That's right. It was a pleasure meeting you, John. I'm looking forward to our debate. Patrick's going down. It's going to be ugly, and I'm glad you'll be there to witness it.
I will. Patrick, Kevin, you guys are awesome. Have a wonderful weekend, and thanking to everyone for listening to the podcast. Be good, guys. Good luck in the market.
All right.
Again,
thanks
John.
a lot, John.